Mr. Hayes, welcome for the first time to Benzinga Live.
Hi, Aaron. Great to be with you.
So quick notes before we start. This is kind of a discombobulated, weird stream. Friday shows are typically a little bit more laid back, fun in general, but today we have this weird thing where I guess no YouTube streams are working, so we're on Twitch right now. But what we're gonna do, if we get some good content from here, we'll cut the clips out and share it. If not, we'll get you back on a day where we're not having start, Tom. Because like I mentioned before we brought you on, you've been on the channel before with Money Mitch, but not here, so we might have a little bit of a different audience. Why don't you start by just introducing yourself and give us some of your experience working with hedge funds, what you're doing now, etc.
Yeah, so I started in hedge funds more than a decade ago. Gosh, it's probably going on 15 years now. And I kind of cut my teeth in a value shop. The principal was good friends with Warren Buffett and the whole value mafia. Lee Cooperman, Mario Gabelli, the initial investors for the fund were of that ilk. Sandy Weil of Citigroup, Mike Bloomberg, Phil Frost of Teva, et cetera. So I really, cut my teeth on Ben Graham's security analysis, the intelligent investor, reading, doing deep fundamental research, doing special situations, and working in that ilk. So kind of in the Warren Buffett type of mindset, deep value. We'd go out to the annual meetings every year, et cetera. And then I moved on from there to a fund called Cornwall Capital. You may remember them from the movie The Big Short. They were one of the few firms who got the financial crisis right in '08 and '09. I joined them after giving them a short soybean trade in summer of 2012. And then a few years later, I started my own fund, Great Hill Capital, which is long short equity. And I keep a research blog on the side called hedgefundtips.com. That's where I post my weekly podcast and video cast with latest market commentary, outlook, etc.
Yeah, well, so it sounds like you've had a fascinating career up to this point. I'd be very curious. I could do a deep dive with you on that short soybean trade because I'm sure you've got some good stories, good insight from there. So as you're running Great Hill, do you stay true to that kind of upbringing you had as a true fundamental value investor? Do you implement different strategies but keep that in the back of your mind as like, all right, that's what I came up with, but this is what I'm doing now?
Yeah, we have a value tilt. We try to buy high quality assets and businesses when they're on deep discount, out of favor, and we have developed a reputation for benefiting during periods of dislocation when a sector or a stock or a group is greatly out of favor, but we can still find that they're high quality and they're trading at a large enough margin of safety. That's when we step in. So we can accept short-term volatility for long-term reward, and we phase in and we phase out of our positions over time.
Trying to buy high value assets at discounts. It seems like a good strategy.
Yeah, exactly. But very few people do it. I was talking to a journalist yesterday, and she said one of her friends was buying a house because everyone was buying houses, and that's just simply not in my DNA. Like when I see everyone chasing something, I'm not a Momo player. I'm the antithesis. I like to buy things when they've been left for dead, and then I'll wait till they turn. And when everyone starts getting excited, that's when we lay them off and rinse and repeat over and over and over. And I think the reason a lot of people don't do it is because it's not easy. They don't give away multi-baggers for free. You have to endure some short-term volatility. You have to know what you own. You don't just buy something that's trading at 30 times sales that's come down to 15 times sales and it's still losing money. You buy businesses that are generating cash, trading at low multiples relative to their historic range, and haven't had any permanent impairment in their earnings power. And that's kind of been our knitting and has worked quite well. And that's what we're going to keep doing. That's what we love to do. And I think that's a good message for your viewers, Aaron, is you have to find a strategy, number one, that works, that number two, that you're good at, and number three, that you're willing to, invest a lot of your time in mastering and be patient with. And for me, it just makes sense when you go through volatile periods like this, when you own high quality assets, even if they move a little against you in the short term, you know what you own, and over time, you're going to work out just fine.
Yeah, so I want to go back on a couple of things because it's I was kind of joking like, oh, buying high quality assets at a discount seems like a great strategy, but it's like I like that, the fact that it's like you're not going out there with some crazy strategy trying to reinvent the wheel. It's like, no, this is what we do. We're trying to find these good names that we can buy that might end up being multi-baggers, like you said. Oftentimes that will include sitting through a volatile period, maybe even sitting on some losses for a little bit. But back to the point too of the woman you were talking about that said, "Oh, my friend's buying a house just because everyone else is." I think that I think like ways how as individuals and individual investors we can try to incorporate some of that mindset of running a hedge fund will allow us to manage our portfolios better and have better positions in the long run than, like you said, just buying a house because everyone else is.
Yeah. There's no question about it. What I suggest, a lot of young college kids come to me and they say, what should I do? For my money, the best thing you could do is read The Intelligent Investor by Ben Graham, number one. And that's the advice that Warren Buffett gives to everyone. And then two, start to read all of Warren Buffett's annual letters. You can find them for free at berkshirehathaway.com and download them. You'll learn more about business reading, those 30 or 40 letters than you would at a 2-year MBA program, and you'll become a better investor for it. Whether you make it ultimately your profession or if you just invest your own money, there's no better teacher than Warren Buffett. Period. And then if your strategy evolves over time based on different interests that you have and different specialties that you have, so be it. Certainly the soybeans trade was not my core strategy that I gave to Cornwall, but I know that they trafficked heavily in derivatives. And there was a unique situation setting up in that soybeans were at an extreme in summer of 2012. And it was basically pricing in that it was never going to rain ever again as long as we lived in the Midwest. And what I looked at was how the commercial hedgers were positioned in the Commitments of Traders report. And they were aggressively short soybeans. And if you look historically, it depends by instrument, but they're usually a good tell. They're usually early and they're usually aggressive. And when you see them at an extreme short or long, that's usually the way things are going to turn out coming forward. And it's interesting right now, we're in a very similar situation with the overall market. I mean, we can talk about the Fed in a second, but right now I look at the US dollar and it just keeps going up and up. Commercial hedgers are aggressively short the US dollar, which means they're preparing for some weakness, which no one is. Everyone's buying the dollar. Why? Because everyone's buying the dollar, just like the guy buying houses. But the last time they were this short were before market peaks in 2020, market peaks in the US dollar. So before US dollar peaks in 2020, 2017, 2015, 2013, 2009, 2006. Maybe this will be the first time in 20 years that the commercial hedgers are wrong, but I wouldn't bet on it. I would bet that we're probably in, whether it's weeks or a couple of months, we're going to see some relief in the US dollar, and that's going to change a lot of the dynamics of this market. The other thing that's surprisingly interesting is commercials are aggressively long 10-year treasuries. Okay, so while they continue to get smoked in the last 2 days since Powell went off on his rant on Wednesday, you basically have the longest they've been since the bottoms in treasuries and the top in yields since 2018, 2014, 2011, 2009. So and by the way, commercial hedgers are aggressively long the S&P 500. So whether we get a turn overnight or it takes a little longer, I look at positioning and I say, it's not it's not a fun environment to be in the last few days. But as you look out and you look historically, the way things are positioned, odds favor we're going to get some relief. And whether that comes, as early as today, I know Chair Powell is speaking at 2 p.m. today, which reminds me an awful lot of December of 2018. I don't know if you were around back then, Aaron, but Chair Powell came out of the gate new to his job, and he decided he was going to say at a press conference on December 19th, 2018, that we're going to just keep quantitative tightening on autopilot, and we're going to tighten regardless of the data. And what happened there was the market was weak going into that meeting. It was down about 6.5%, 7%. He turned that into a 16% correction or crash in the next 4 days. The day before Christmas Eve on Sunday, Stephen Mnuchin, who was our Treasury Secretary, had to call the 6 largest banks to round up ample liquidity for when the market opened up on Christmas Eve the next day. and they backstopped the market. 3 or 4 days later, Powell went out on a public meeting like he's going to have today, and he walked back his statements. He said, "Oh, did I say autopilot? What I really meant was we're going to be flexible with our tools." And within 3 months, the market was at new highs off of that huge crash that could have been a complete disaster if Secretary Mnuchin didn't turn things around. So, Chair Powell has a history of making big mistakes. He did it in December of 2018. He did it last year. He thought that they had, last September, if you look at the meeting minutes, September 2021, the press conference, he basically had estimates that inflation was going to be 4.2% for this year, and he thought that 10 basis points on the Fed funds rate was going to be a good idea. And sure enough, inflation went well beyond 4.2. And now you have inflation coming down, the economy in a recession. We've had 2 quarters of negative GDP, and we're probably going to have a third. If you look at the Atlanta GDP now, is at 0.3% for Q3. It looks exactly like it did last quarter before it rolled over. So we're already in a recession, and this guy is now looking at 4.6% on the Fed funds rate, with all the commodities rolling over, most of the key leading indicators, PPI rolling over. So he does the exact wrong thing at the exact wrong time. When inflation looked like it was taking off, he was dovish. When inflation now looks like it's rolling over, he's getting hawkish, and he risks driving the economy into a ditch. So he's got a chance to walk that back this afternoon. Whether that'll happen or not, or if he needs another 1,000 points down on the Dow, is very hard to interpret. So far, his actions have not been logical. So moving forward, we'll see when he pivots. But I wouldn't be surprised if he walked back that harsh hawkish language a little bit this afternoon, and the market took some comfort in that more rational speaking.
Yeah, I think that's really, I do remember looking back on 18, I think, and that Christmas Eve ended up marking that bottom, actually. And right now, so I just want to make sure I got this right. You're saying right now, professional hedgers are betting that this parabolic move that we've seen in the dollar right now, it's showing the dollar against the euro, but whether you want to look at the dollar against the yen or the pound, it all looks the same. You're saying that professional hedgers are betting that this parabolic move stops, reverses, essentially not keep going in this direction.
Correct. Yeah, that's correct. And they're usually early, so it could go a little more before it levels out. But the key thing here is whether it corrects or it reverses. The key is it stops going up. Even if it grinds sideways for a little bit, it needs some relief. Right now, it's a one-way street, and the market doesn't know what to do with it, and that's why you're seeing a tremendous amount of volatility. And that's largely a function of that very aggressive forward guidance that we got on Wednesday, which was really not warranted. I mean, this is like, I don't know if you play golf, Aaron, but it's basically like you're 25 yards away from the green, and rather than pulling out your lob wedge and sticking it close to the pin, you pull out your driver and you drive it 250 yards past the green. It makes absolutely no sense. They've already destroyed demand. You see that in the GDP numbers. You see it in the commodities. You're starting to see it in the key inflation numbers and leading indicators. You got to give it time to work. Something like 86 hikes since 1983. 75 of them were 50 basis points or less. We just had 3 emergency rate hikes in a row. You got to give them time to work through the system. And the correct thing to have said on Wednesday was, we are committed to inflation. We're seeing signs that it's coming down, but we're not going to be casual. We've just done 3 emergency hikes. We're prepared to go another 150 basis points before year end. However, we will be data dependent. If we do see signs that inflation is continuing to roll over, we'll go more modestly and allow the lagged effect of policy to take in place. They did not do that. Maybe we'll get a little taste of that this afternoon. If not, it'll be a little more damage before they have to finally pivot. But pivot they will, and that's how things are positioned. If you look at institutional investors, they have their highest cash levels since 2009 and 2001. Before that, those were periods where you wanted to be a buyer, not a seller. Recession expectations are the highest since April of 2020. If you remember, the market bottomed in March of 2020. And then before that, March of 2009, which was the bottom of the great financial crisis. So oftentimes, The pessimism is acute because the recession hasn't yet been declared. My sense is it will be declared somewhere around March 9th. And we'll look back and say, oh yeah, we were in a recession, and often the market bottoms well before it's officially declared. So I think that's where we're at, and we've got a little more volatility to work through, but eventually the Fed has to ease up on that language.
Yeah, is March? Are we getting GDP data around that time, or why do you say specifically March 9th?
I meant November 9th. It's the day after the election.
Oh, okay. I was curious what
Yeah.
the
Yeah.
specific.
I was tied into March 9th being the March of 2009. But no, my sense is it'll be declared a recession sometime after November, after the election, and we'll look back and say that's a rearview mirror event. We'll probably see a third quarter of negative GDP for Q3. That'll cement it. They'll declare it, and then everyone will know the recession's largely in the rearview mirror, and the bottom of the market historically has come before it's officially declared.
Yeah, and we see that all the time, right? And you see
Yeah.
that thought being put out there, essentially, that remember that markets bottom before the end of the recession, not, or during the recession, essentially, not after.
Exactly. By the time they
Going
declare
back,
it, it's already too late. Yeah.
yeah, and by the way, I think we're in like complete agreement. I love everything you've said, because I think you're putting forward a lot of the same points or thoughts that I have, but probably in a way a little bit more articulately and with a little bit more experience. Huh?
Thank you.
Oh, sorry. I just got note we're back on YouTube, because I agree. Like the Fed right now, and I've been saying this. I've had different economists on the show talking about it. Like at the end of the day, we've known, or at least a lot of people have foreseen the instance that we're raising rates, but it's not going to do anything to fix the supply side issues of inflation. It's like crazy. Like you look at something like rent right now, or housing prices. It's like we're still in a housing shortage. Rent prices are skyrocketing. Let's make investing in new housing harder to do. It makes literally no sense, backwards to me. But again, I just like the Fed has one thing in its toolbox, and it's raising rates. So it's going to open its toolbox and do it, whether it's going to help or not. It's silly. It's annoying to me, because I feel like we can't have a normal conversation about it. There's obviously a lot of politics baked into it, but it's just blasphemous to me, essentially, that the Fed can get away with doing this when it makes no economic sense, to me at least. So it's good. I'm glad I'm hearing this from someone else as well.
Yeah, I mean, look, the supply chain issues are easing up. We used to have 120 ships sitting outside the port in Long Beach. Now it's like 6 or 8. So the supply chain is easing up. These things all work on a lagged basis. And the problem is they're being impatient and not allowing it to work through the system. As far as housing, you are seeing how housing prices weaken. Rents are a lagging indicator. The other thing is that the way rents are calculated, owner's equivalent rent, changed, and it's actually impacted the numbers and made them kind of misleading to the upside. So there are a lot of things. We see it even with commodities. All started rolling over in June. Now we're seeing it at the pump. So these things take time. But consumer confidence bottomed with gas prices peaking in June. So that was the lowest print of 51. I think we're up to 58 or 59 on consumer confidence, and inflation are joined at the hips. If you look at 5-year inflation break-evens, last I looked, they were down to like 247 from 359 just in March. So, everyone other than Jay Powell seems to know inflation is coming down and you need to be patient. Instead, they keep jamming these hikes in the forward guidance. Now, that's the bad news. The good news is talk is cheap. I mean, they've been very aggressive with their talk. They certainly couldn't be more aggressive with their talk. But in the whole scheme of things, today, we're at 3.25 on the Fed funds rate, which is historically low and may be okay. The question is, do they jam through another 125 or 150 before the end of the year? And I just don't think the market and the economy will be able to digest that, because the first of the emergency cuts is going to start to trickle into the economy, and we're going to see an abrupt halt to activity and demand destruction if they keep at this pace. So, it's kind of tale of two cities, Charles Dickens. We'll see what they do next. I think 2 o'clock today will be an important meeting. If they don't do anything to walk things back and speak a little bit more rationally, then we'll have some more pain in the markets before something changes. And but
Yeah,
we've been to this movie before.
right, and that's kind of the good news is the worse things get, whether you're looking at the stock market specifically or the overall economy, right? Businesses feeling the pain. The worse things get, the closer we are to the Fed having to walk these things back and essentially start either not necessarily cutting rates, but slowing its rate hikes, et cetera. So, like you said, we've seen this before. The last thing I'm curious about and wanted to talk to you about, Tom, is on the content side, because I like that you seem interested in, you manage the website and have the newsletter and stuff. Why is it essentially like important to you to put this content out there? For most people, hedge funds are very secretive, work behind closed doors, don't get access to a lot of the equity research that funds do. Do you feel you're doing things, I guess, kind of differently than a lot of other firms out there?
Yeah, I think it helps to clarify our own thinking process. When you put things out there publicly, you really have to give it a lot of thought and a lot of preparation, et cetera. So it keeps us constantly sharp, constantly on top of everything that's out there. And it's the old kind of golden rule, right? If you do good and you put a lot of good out there, a lot of good things come back to you. And we found that to be true, and we found it to be very helpful, and a lot of people coming back and thanking us and learning stuff that they didn't know, and a lot of gratitude. So we continue to do it. As long as people support it and watch it and share it with their friends, we'll continue to do it, and we'll go from there. But no, we could certainly just sit back and manage our own money and our clients' money and do our own thing. I think people have gotten a lot of great value out of it over the last 3 years. We've gotten a lot of great feedback. It's continued to grow. So we'll continue to do it.
Yeah, and I mean, that goes hand in hand with our mission here at Benzinga of trying to kind of democratize financial news and information for the everyday person. I personally, I come from more of a media, I went to journalism school, but I've always been interested in the stock market and investing. So this has been like a great, job for me, kind of blending my two interests together. But I've thought about personally, like, well, why don't I just put out some of my research out there and seeing it. If people like it, then they like it. If not, then they don't. Would you recommend, people doing that, like putting out, like if I put out a great research report that outlines a short soybean trade like you did in 2012, maybe someone out there in the ether likes it and picks it up and wants to do more with that? I don't know.
Yeah, well, I would say be very careful putting out short research publicly. We don't tend to do that. That was done privately to
Okay.
them, because then you get a lot of people shooting against you. But if you do high quality research and high quality businesses that over time are going to work out, and people can withstand some short term volatility, I think it's a home run. But you got to do your work. You don't want to put out sloppy stuff and that doesn't help you and doesn't help them. You have to really know what you own. Do the background research, and certainly sharing is good, because at the very least you'll get people come back and say, hey, this is why I think this is what I think your thesis is missing, or have you thought about this? And maybe you'll go back to the drawing board and you'll say, oh, I didn't consider that at all. Maybe I should get out of this position. Let's look for new places to allocate the capital. So it can be a very helpful process if you do it, carefully and responsibly, and really do put the work behind it. But the hardest part is getting out there. It's a little bit nerve-wracking initially. But if you do it, you get better at it over time. And like probably when you started doing your media, I mean, imagine the first time you conducted an interview, you're probably a little nervous, and now you're a seasoned pro. So it's like anything else. You just got to get on the bike and give it a whirl.
Yeah, and I wouldn't consider myself a seasoned pro, but definitely I think I've had improvement since I started doing it. And it reminds me, like, one thing we were taught in journalism school was like, you don't judge a piece of an article or a piece of journalism based on the author, the person doing it. You judge it based on the criteria, like you're saying. So like, someone no name can write a great article and it can be like great journalism. They did the work, like you're saying, actually do the work, versus on the flip side, some New York Times journalist can put out an article that has a lot of inaccuracies in it. So instead of judging it like based on, oh, this firm put out this or this, judging it based on the actual content as opposed to the person doing it. basically my thought there is like would some if I did say me, and I'm not saying I'm going to do this, but say I did put out 5 great research reports in a row on longs, they all ended up working out. Would a fund or someone like you see that and say, okay, that's great, but that kid doesn't have like an MBA or anything, or see that and say, oh, that kid knows what he's talking about?
Yeah, a lot of college kids ask me this. I would say if you're looking in that regard, you're probably better off going directly to the funds that you want to do and present your ideas and developing that relationship over time versus putting it out publicly. Although Michael Burry had a blog in the late '90s, and that's how he got capitalized by.
Scion was his own.
Scion, yeah, but he was funded by not Bruce Greenwald, but the guy who does that little blue book that beats the markets, Greenblatt. Joel Greenblatt, I think, was one of his first financiers. He was running the blog while he was, I think, working as a doctor or an intern, and he really put out high quality value research over time. And people will follow you for years. I get people that say, I've been listening to your podcast for 3 years. I want to invest with you. Can you talk to me about how that works? It's good to put out a lot of good stuff. If for nothing else, then to consistently sharpen your own skills, put it out for public consumption, get feedback, refine your process, get better, and move from there. But in terms of like, if you're trying to get a job at a particular fund, I would put together your best ideas and send it to the fund versus just putting them out publicly.
Yeah, and I'm half asking kind of for myself, but also
for your audience.
That's our audience that are like they're interested in finance, but they don't have the degree and they want to know how they can get involved. But I'll make a deal with you, Tom. So with that said, if I put together some good equity research, I'll come to you first. I'll privately, pitch it to you. If you hate it, turn me down, then I'll go the public route. I'll give you the first dibs.
Fair enough. Yeah, and I think for people that want to get into equity management and that type of thing, probably one of the things they can do at a young age is start to read the CFA books and really get a background in analysis and the skills of the business that will give them more confidence to make solid presentations and kind of understand the language of the business. So, it's like you have to go to a little bit of plumber school before you go out and start, installing pipes in new home construction, right? Because you don't want to wing it and it can be catastrophic.
You're saying essentially you don't necessarily need to go get your MBA, but picking up a few CFA books and understanding how these presentations and reports work will help you a little bit.
Yeah, well, it's certainly a process, and you have to have the basic skills. So what I say to people, again, start with the Intelligent Investor right there. That'll show you if you actually want to pursue it or not. That'll save you a lot of time. 2, I would do all the Warren Buffett annual letters. And 3, start to read the CFA books so you have a grounding in kind of the basic language and understanding of analysis in the business if you're going to go the equity route.
Yeah, and like Tom said, the first time you put together an equity research report, probably not going to be fantastic, but Warren Buffett's first one probably wasn't fantastic either. But if you keep doing it, you're going to keep getting better.
Exactly.
All right, Tom. Well, it's been a pleasure to have you on today. I'm glad we got a chance to get you on the show, even though it's been kind of a wacky day with all these tech issues. So again, maybe on a subsequent visit, we'll have a little bit more of a normal show. But man, enjoy the rest of your Friday. Have a good weekend, and we'll chat soon.
All right. Thanks so much, Aaron. Have a good one.
Of course. And real quick before you go, where can audience folks find more from you? If they want to sign up for your newsletter, et cetera.
Yeah, go to hedgefundtips.com. All of our podcast, our weekly free podcast, video cast is there, our weekly research notes, and a lot of great stuff. So check that out. You can also add your email on the website. Just scroll down, enter your email. You'll get our daily email and newsletter. And I think you'll find that very helpful moving forward.
Beautiful. Hedgefundtips.com. Got that in the chat. You can also follow Tom on Twitter at that same name, at hedgefundtips. Tom, again, can't thank you enough for coming on. It's been a great conversation.
Appreciate it, Aaron. Have a good one.
You do the same.